Today, I'm going to show you a simple strategy for indirectly moving dollars from an inherited IRA into your 401k. That's what we're talking about. Let's get going. Now, more specifically, today we're talking about inherited IRAs from a non-spouse. So classically, think inheriting an account, an IRA, from your parents or your grandparents or some other relative. The issue with these is since a 2020 tax law was passed, the rules around these have tightened up, and most notably, there's a new rule that says the dollars in these accounts needs to be fully withdrawn within a 10-year time frame. Now, the 10-year clock can really create some tax challenges for folks, especially those that inherit rather large IRAs. Think well into the six figures. And I've had a number of cases just like that over just the last handful of years. Now, the problem is when you start pulling dollars out of these accounts, most of the time they're comprised solely of pre-tax dollars. So what it does is it pushes your income up into those higher marginal tax brackets. And a lot of my clients that I've worked with, they don't need the money, especially in the next 10 years. So they would rather sock this away and use it for their own retirement, which could be beyond 10 years out. So we've had to come up with different approaches for dealing with this. And one of the approaches has been trying to, again, indirectly shift money from these inherited IRA accounts into 401ks. Now, in just a minute, I'm going to show you an example to illustrate this idea. But before I do, let me talk about two things you have to have going for you. Number one, you still got to be working and contributing to an active 401k plan. Number two, you can't already be maxing out your 401k. All right, in 2024, the contribution limit, if you're under age 50, is $23,000. If you're over 50, you can do an extra $7,500 for a total of $30,500. But again, you can't already be maxing out. You have to have some room to make extra contributions in order to implement this strategy. Now let's look at a simple example to bring this whole thing together. So imagine Bob, he's age 55, his mother recently passed away, so he inherited an IRA from her with a value of $100,000. Now Bob is still working, he's making about $150,000 per year, and he's presently contributing 10% of his earnings to his company 401k plan, which of course works out to about $15,000. Now, as we already talked about, because Bob's over 50, he can contribute up to $30,500, which means he has this opportunity to add an additional $15,500. Now, let's expand on this even further and assume that Bob is in one of these situations I described earlier. Bob does not need this $100,000 today. And he doesn't need it within the 10 years. What he really wants to do is just use this to supplement his own retirement so he can draw these funds out whenever he so chooses in the future. So one way of approaching this is utilizing this extra $15,500 that he could be contributing to his 401k. Now, I think at the beginning of the video, I said this strategy is an approach to indirectly fund a 401k with inherited IRA money. Now, indirectly is the key word here. Okay, Bob cannot simply transfer money from his inherited IRA into his 401k. Okay, can't be done. But here's what he could do. Bob could ratchet up his 401k deferral. I mean, he basically would have to double this. So he would be hitting this maximum $30,500 for 2024. Now, of course, that's going to lower his take-home pay on a, assume he gets paid bi-weekly. But what we could do is exactly offset this additional money that's going into the 401k by having Bob take a $15,500 distribution from his inherited IRA here in 2024. Now, just a few last comments here. What we're doing from a tax perspective, when we're taking $15,500 from the inherited IRA, we're creating a taxable event. Okay, Bob's going to have $15,500 of extra income hitting his tax return because this is all pre-tax money. But what we're doing is we're perfectly offsetting that by increasing his 401k deferral by the exact same dollar amount. So these two end up being a wash, and this is how you can effectively move money, again, indirectly without any taxes, from one of these inherited IRAs to a 401k. Now, finally, we used a pretty simple example talking about Bob, but obviously if Bob's married and his wife also works somewhere where she has a 401k, where she can make additional contributions beyond what she's doing, that could increase the amount even further of which Bob could take distributions from that inherited IRA. Okay, it doesn't just have to be him so long as him and his wife are filing a joint tax return. And of course, we could even expand this further. You know, if you're someone who isn't participating in a 401k plan, you could, again, assuming you're eligible based on your income and so forth, make contributions to an IRA, a health savings account, some of these other types of things that give you a tax deduction. The key thing that you need to remember is whatever dollar amount you pull out of the inherited IRA, whatever's that number is that's going to hit your tax return, you want to make sure you're offsetting that with an equal contribution to one of these pre-tax accounts. So anyway, this is just kind of a simple, creative strategy that I've put together with a handful of clients, helping them deal with these inherited IRAs. Tax planning is a core part of what I do for folks in the retirement planning process. If you want more information about it, check out my website. I'll put it in the description here if you're watching on YouTube. As always, just want to say thanks for watching. I hope we'll see you on the next one.